Greetings everyone, Jake Bernstein, Weekly Capital Markets Report. Trading lesson. Aren't you happy? So it's 7:30 in the morning, Sunday, November the 11th. Let me give you a little trading lesson. If you have suggestions as to what you'd like me to cover in these lessons, please let me know. I'm always available for input. Always open to your suggestions. So what's the deal? The deal is really simple. Let's talk about Commitment of Traders Report. I'm sure you've heard about the Commitment of Traders Report, probably seen me talk about it many times, heard me talk about it many times. Maybe you're sick of it, maybe you understand it, maybe you don't. But let me give you my perspective on it. The Commitment of Traders Report comes out once a week, issued by the US government, and gives you a breakdown of different trader categories in the market, showing the number of long positions they have, the number of short positions they have, and the changes from one week to the next. When the report comes out, it's about a week old. So don't use the COT report for short-term trading. Now, we can look at the COT report in a number of different ways, and many people do. The report basically, in a number of different categories, shows the number of short and long positions for small traders, speculators, and commercials. Commercials are the end users, the people who produce the stuff or who use the stuff. They are the most important group in the report. I don't look much at the small trader or the speculator. I look at the commercials because I want to know what the big traders are doing. You can show the COT on a chart. You can show net long positions, net short positions, and many different breakdowns. I look at simply the COT Commercials Index, which is a sum total of the longs versus the shorts. So let's say there's 100,000 contracts out there that are available in the market. And of those 100,000 contracts, commercials hold 80,000 of them. Of those 80,000, let's say there's 40,000 commercials that are long, 40,000 contracts held by commercial short. The net difference between the two will be zero. There'll be no advantage one way or another. So when the COT shows as positive on this metric, COT commercials, it means there are more commercials that are long than there are that are short or hedged. Remember, this does not mean that every commercial is long the market. Commercials do different things. Some are producers, some are hedgers, some are end users. The bottom line is this. It means there are more commercials that are long than there are short. And so relatively speaking, looking at coffee, for example, you can see that in the coffee market just recently, there was a huge 75,000 approximately long position net difference between the longs and the short. 83,000 actually, let me see that number. About 81,000. It's a very significant indication because commercial buying activity leads bottoms, as it did here or here. And if you scroll back and you look at the history, you will see that. Come on, computer, cooperate with me. One moment, please. As you look back at the history, you'll see that commercial buying activity tended to precede many significant bottoms in many markets, including coffee and others. So the bottom line is this. Look at the number of contracts. And let me change this to a quarterly chart. Look at it this way. Since the government started reporting Commitment of Traders data back in the 1980s, you can see that there have been a number of times when commercials have been long the market, preceding major up moves or correlated with bottoms. Commercial activity now is the largest on the long side it has ever been. We use this as a prediction and combine it with timing. The prediction is that coffee futures, coffee prices will make their biggest move ever because commercials hold the largest long position ever. It's logical and it's simple to understand. This is not a guarantee, but because it's a setup and a leading indicator of major moves, for example this last one here, which encompassed a gigantic dollar move per contract, we want to pay attention to it and correlate it with timing and cycles. So the forecast is a forecast. It's long term, it's not short term. COT should not be used for short term trading, but understand what the numbers mean. Look at this one. Silver. Here's the silver chart. Moment, please. What are commercials doing now in silver? Well, look. It's just a little blip on the chart, but it's the first time I've seen that blip. In the entire history of the COT in silver, this is the first time I've seen it blip to the upside. In other words, let me put it on a smaller time frame, like a weekly chart, and come over here. What do we see? For the first time, I believe ever, I could be wrong, but I believe ever, for the first time we've seen commercial buying activity in silver. Meaning what? Meaning they're finding it cheaper to buy silver on futures than it is to mine silver, which is why they're accumulating positions. If this happens again, this would be very bullish for silver. But look at this. Gold. And what do we see in gold? The same thing, commercial buying activity. And one more time, platinum. Here's a platinum. What do we see? The same thing, right at the bottom. Now look, there's no guarantee here. Various people have suggested this is all a ruse, that commercials are doing this to trick people into buying the markets. I'm not so sure about that. All I know is if you combine the cycle with the COT, with timing, you've got an excellent combination for long-term investing. Not for trading, but long-term investing. That does it for today. I hope you enjoyed the lesson. If you have any suggestions or questions, jake@trade-futures.com. Take advantage of my year-end specials. They're good and they save you a lot of money. And best of trading to you. Thanks again.